Hi everyone, welcome back to Swatantra. At Swatantra, we simplify investing, and I have Jaydeep with me again. And this time, what we are going to do is we are going to simplify debt markets. Jaydeep, when I read the news, I read Economic Times, I watch on TV and Twitter. A lot of people are talking about bonds, about investing in fixed income instruments, right? On one hand, you have fixed deposits which people are saying, you'll never make wealth through fixed deposits. And on the other hand, you have volatility in stocks, in crypto, even to a large extent, even in real estate. So, can you just set the context like 101 for debt? How can that be an investment vehicle?
So, Darshan, debt is not a small instrument anymore. Almost 46 lakh crores of investments in India today are in the form of fixed deposits. 95% of India's population has been involved in investing in fixed deposits or debt. And as you rightly said, it's the most exciting time for one to, or the best asset class, I would say, in current situation, if somebody is looking for assured returns. If you see empirically, governments have never borrowed at such high rates, and inflation has never been at so high levels, elevated levels. Globally, everywhere, if you see, it is like inflation is at almost 40-year high, 50-year high, and that's why the borrowing rates of governments have shot up very sharply in a very short span. And this excites me, and definitely today our podcast is going to help this 95% of the population of our country in understanding how they can make more than what the assured coupon is or what the assured rate is. Because in debt, when interest rates go down, the bond prices go up, and when interest rates go up, the bond prices go down. And today I think we are somewhere close to the peak, and if we start make some sensible allocation in the days to come, definitely I think our investors will experience a great capital appreciation over a period of time.
Okay, so one part is, I want you to simplify this a little bit, right? One part of this, I know you're going to walk through in this podcast a simple case study and you're going to run us through the numbers, really coach us, of how this works and what is the math behind it, the quant behind it, the research behind it, okay? So I'm really grateful and excited to see that. But before we get there, I want to invest my money and I have invested in different asset classes. What kind of returns can I expect from this instrument?
Assuming your duration is about 10 years and keeping certain assumptions in mind, one of them being that in next 3 years interest rates will come down from where they are today, we should land up getting some anywhere between 8 to 10% returns on a government security. On the higher side, it could, and in the last cycle, we have earned almost 14% returns.
Wow.
On government security. So, good quality papers, hold them till maturity if you want, because today's rates are anyways at elevated prices, and there is an opportunity to make additional income if you sell them in between when the interest rates are low. So, we are going to help people understand how to invest in bonds, what are the benefits of investing in bonds, what is the taxation, and what kind of which investors should go for, because there are a lot of investors who don't want fixed income. They don't want the payouts every month. And is there a way? A lot of people don't know how can they get exposure to government bonds and at the same time not take regular income from it. Because they are planning it for the next 20 years. So I am typically looking at a bond for 2045 from my retirement point of view or from my debt allocation point of view. These are instruments where I will not be taking any payouts for next 10, 15 years, 20 years.
Brilliant. So I'm just going to recap before we go into the research and the numbers that you run through. This is more secure or more safe as an investment vehicle than what you would find out there.
It's the safest. So we are going to invest in sovereign bonds.
In sovereign bonds.
So
if the government fails,
that's it. So we are the risk element we are taking. In terms of default is absolutely taken.
And so almost you're kind of getting or expecting 9% to 15%, whatever it might be, right? Which is as secure as it can be, and that's good amount of money. And you can, over a period of 10-year, 20-year, 15-year period, there is a window of opportunity right now for us to create some decent amount of returns and good wealth. So now that being said, why don't you walk us through what you prepared for us?
Yeah.
And I'm super excited to learn how this works.
Yeah. So just to give a last update, if we make long-term returns in equity, we consider anywhere between 12 and 15%. And obviously, it has an added element of risk, which everybody, all of us know, when markets go up and down by almost 30-40% or at times even 50%. But here we are talking about certain debt instruments which are sovereign and can fetch you a return anywhere close to 10%, which is fabulous. And it is not that we can generate these kind of returns every time. There are cycles, and we are going to talk about the cycle that we are into today. I hope you get to know. We are trying to simplify things here again and make sure that because we come out of this traditional way of investing in fixed deposits and understand the small maths behind it and the little bit about taxation and how we can save on it. So yes, we'll be talking about few important terms that we are going to use now. The most important one is tenure, then this face value, then is coupon rate, then YTM. All these terms, if you can see, we are just trying to explain you what they are. So if you see, what we generally are used to is buying a fixed deposit or investing in a fixed deposit where the tenure is fixed. Let's assume it is 5 years. And the face value of bond or the FD is say 1,000 rupees. Just for ease of understanding is what we are trying to do here. It could be 10 lakhs, it could be 1 lakh. And then there is a coupon rate which is fixed for the entire duration of the fixed deposit that you do or the bond that you buy, which is 7% per annum. Now, if you see, what happens typically is we have invested on time 0, which 1,000 rupees. That's why we have tried to show that there is a negative outflow of 1,000 rupees from your pocket, and every year you get 7% interest, which is 70 rupees every year till year 5. On the last day of on the maturity, you get your 1,000 back plus the coupon or the fixed deposit interest that you have been assured, about 70 rupees. So your net cash flow is pretty linear here and nothing changes over the period of the time. But now there are a few things that we need to understand is the price of the bond. The price keeps going up and down during the tenure of the bond. So say if you have invested today at 1,000 rupees at the primary issuance, and it could be possible that for some reason interest rates have come down, tomorrow the YTM of the bond can go down and you could land up getting the price will keep changing, is what we are trying to say here. So one has to know why the bond prices changes. Now there are typically 3-4 reasons that we want to highlight here. One is change in inflation expectation. So inflation keeps as the inflation rises, the bond yields also go up, and if inflation falls, the bond yields also fall. Similarly, demand and supply of money, like the governments decide to infuse money in the system by keeping the interest rates lower. Then is typically what happened during the COVID times. All the governments globally came out and printed a lot of money, so that and this is also one of the reason for the change in bond prices. Third is the financials or the change in rating of the company or the country. Now, as you all know that even India has a rating, and similar to what maybe a Bajaj Finance or Reliance or HDFC or TCS has. So if the rating changes based on the financials of the company, and the bond prices will also keep changing because of the change in rating. So if your rating improves, the bond yields will fall for the company, and if your rating doesn't improve or it degrades, then it's going to go up. It's like you're going to borrow at higher cost. So changing financials and ratings are one of the important factors for changing price of the bond. Last option is time to maturity. Now time to maturity is important because for shorter duration, if you see, you will be rewarded with lower interest rate because the risks are lower, and for a longer duration there's a lot of uncertainty. Things like COVID can happen where interest rates can move up and down, and that's why one lands up paying higher interest rate. We are trying to show this in a graph here. If you see, the yields for shorter tenure is roughly somewhere between 3 and 4%, and as you go longer, or say for 10 years or 15 years, the interest rates, these are typical government rates. We have just fetched them from the internet, and the for the shorter duration the borrowing cost is lower, and for the longer duration the borrowing costs are higher, and after a point obviously it plateaus down. So this yield curve is a very good explanation for why time to maturity is important, and the change in price also. So going back to the example where we have invested in a bond for 5 years. Now what happens to a bond if you want to sell it at year 3? We have tried to capture this in one of the examples, and as I told you earlier, time to maturity plays an important role. Now here time to maturity for the bond that we had bought is only 2 years, because 3 years we have already held on to the bond. So what happens typically is, if you see in the graph, on the first year you receive 70, second year again you receive 70 rupees, third year you decide to sell the bond, and what happens is the interest rate for 2 years is now 4%. So if initially you had bought the bond with a 5-year tenure for 7%, and now there is only 2 years left for the bond to mature, so obviously, like I said, the time duration has come down, and time to maturity is only 2 years. So the interest rates we have assumed here as to be 4%. Now at this juncture, the price of the bond, which was 1000 earlier, has changed to 1056 rupees. And this is typically the appreciation that one would get when he tries to sell the bond at year 3. Now how does this cash flow work now? If one decides to sell the bond at year 3, the year 1 he gives 1000 rupees to the bond or to the company or the government bond that he buys. Year 1 he receives 70 rupees, year 2 he receives 70 rupees. Year 3 when he sells the bond, he receives 1056 rupees plus the 70 rupees interest that he gets. So his net return for the bond is 8.17, whereas if you see what was committed to him when he bought the bond was 7%. Now since the interest rates have come down from 7% to 4%, there is a capital appreciation of 56 rupees, and there is a coupon which he got 70 rupees, which was assured to him on day 1, has also been received, and that's how 1126 rupees price has arrived, and his net returns had turned out to be 8.71%. So assuming today's situation, if we have, if we think that the bonds interest rates are likely to come down 3 years from now, so if you buy a bond with a maturity of 5 years, which is with a coupon of 7%, and if interest rates come down by 2%, 3%, and you decide to sell it on year 3, you're likely to get somewhere between 8.71% returns as shown in the explanation. Obviously, these are assumptions. These are not actual figures, but there is some kind of anticipation that interest rates would not stay so elevated for such a long period of time, and all the steps that governments are taking to reduce inflation will go in their direction. Now to simplify things further, we are going to talk to you about how change in interest rates impact the price of the bond. I have told you, say one of the earlier example we saw how tenure makes a difference, or time duration or time to maturity makes a difference. Now here we are going to talk to you about change in interest rates. So what we have tried to do here is, if there is a 1% change in interest rate, what would be the price of the bond? And assuming that there is a 2 years for maturity. So assuming that if we go for 2-year maturity, and if interest rates come down, there is only 2 years is remaining for maturity, and interest rates come down by 1%, that means from 7% they come to 6%, then the price of the bond goes up. I had initially told you that if interest rates come down, the price of the bond goes up. Unlike stock markets, it's exactly opposite. Where interest rates come down, the price of the bond will go up. And if you see from 1000 rupees, the bond has turned out to be 1018 rupees, and his net returns would be 8.83%. If similarly, if interest rates move up by 1%, and this is very critical to understand, if interest rates move up by 1%, the price of the bond will fall. Okay, and if you see here, the 1000 rupee bond which we had is now available at 982 rupees. That means you have almost lost about 18 rupees in this bond because of 1% rise in interest rate. If you decide to sell after 1% rise in interest rate, you would land up getting only 5.22% return. So what I am trying to explain here is, If you hold the bond till maturity, you get only 70 rupees every year plus the 1000 rupees that you had invested initially. Now what we are trying to talk here is, if we decide to exit in between, in between, say about 3 years, if we decide that we don't want the bond and we want to invest this money somewhere else, then what would be the scenario? And 3 years from now, if interest rates are higher, what would be your net returns? And 3 years from now, if interest rates would be lower by 1%, what would be your returns? So this is what we are trying to tell you, and how price movements, change in interest rates impact the price of the bond. Similarly, now what we are trying to tell you is, if the time period is 10 years, if time to maturity is 10 years, or the tenure for your bond to mature is 10 years, then how much does one make, and what would be the kind of returns that he would generate? Obviously, if, like I told you initially in the graph, that if you buy a bond for longer duration, the interest rates would be higher. So similarly, earlier example, we had assumed only 2 years maturity, and now we are assuming that the bond would mature in 10 years. So 10 years, obviously the bond price, if bond price moved up by 1%, you would lose drastically. From 1000 rupees investment would become 932 rupees. The price of the bond would fall to 932, and you would straight away lose the entire interest that you would make, or entire coupon amount that one would have expected. Now here the basic assumption is, you bought the bond yesterday and today the interest rates have fallen. In the earlier case, what we had assumed was, the bond was what, 3 years ago, and it had another 2 years to mature, and then interest rates changed. Here what we are assuming is, there is a COVID kind of situation when the governor comes and he says tomorrow onwards interest rates for 10-year bond will be higher by 1%. So if he increases or decreases the interest rates, then if you remember, during the COVID times, all the governors across the globe had cut down interest rates to make sure that they incentivize spending and businesses do survive. So what they tried to do was nothing but, and if you had bought the bond one day before, then you would have gained straight away 14% in one day. And how it would have happened is, because your time to maturity is 10 years, and the interest coupon that the bond that you had bought is for 7%, and if somebody decides to buy the bond on the very next day, when the interest rates are down, he would only get 6% returns. So you would get a capital gain of 73 rupees in this case. Whereas if the interest rates move up, like how recently the Fed in the US has increased interest rates by 0.75 basis points, for ease of understanding, the bond prices will come down from 1000 rupees, they will land up somewhere near 932 rupees. Now obviously there is a precise calculation for this, but as a thumb rule, we have just tried to explain you with the net calculation straight away here. We are not getting too deep, because the bond prices will automatically capture the right price. And since we are talking about government securities, the price discovery would be quite uniform and quite easy for everybody. So what we are trying to do next is talk about the investment options that one has, and the tax working about it, and the working and the tax point of view also. So assume that if one had decided to take a fixed deposit in HDFC or SBI for 5 years, the normal interest rates are anywhere between 5.95 to 6%. And if he decides, and if assuming that he is in the higher tax bracket, he would pay about 31% tax on this 6%, and land up getting anywhere between 4.12 to 4.2% returns. The tax that he has lost, or the interest absolute form is lost due to tax, is about 1.88%. Now what about the liquidity point of view? If you see, if you do a fixed deposit, the liquidity, there is a penalty for every fixed deposit that you premature. So if you decide after 3 years, a 5-year fixed deposit, and you decide on the 3rd year that you want to exit it, obviously they are going to charge you some kind of penalty, and that's another impact cost that's going to reduce your interest or reduce your take home returns. And there's something called as mark to market, which means like I told you, the bond prices move up, then the prices fall, and the fall is nothing but mark to market loss or gain in either case. So in fixed deposit, there is nothing such as mark to market. Whatever is assured to you on day 1 is delivered to you on the last day along with the principal amount. But now here we go, and if we decide to buy a bond directly in demat, say if we decide to buy a 5-year GSEC government security in demat form, and currently it's assuming that the current rates are somewhere around 7%, slightly higher, but we have just, for ease of understanding, we have kept it 7 here. And they would have a semi-annual payout. So every 6 months they would be paying you interest by on a fixed date. The taxation on the interest that you earn would be same as what you have got on a fixed deposit in a bank. So it would be quite similar to that. So your take home returns would be anywhere between 4.8 to 4.85, whereas in banks, if we saw, it was about 4.12. So slightly higher than banks, because the coupon of the 5-year government security, governments are borrowing at higher rate, and that's why you have landed up getting slightly higher returns here. Again, the loss of tax, or the returns lost due to tax is about 2.2%. And liquidity point of view, the government bonds are highly liquid. Anytime you want, you can exit them without any penalty. It's all depends on the price that it is traded to, and that's why we are saying that it has medium. It's not as liquid as a mutual fund, but definitely it's better than a fixed deposit where you pay some kind of penalty. Here at least there is no penalty, and hence you decide to exit anywhere in during the course of the investment. Then you just have to find a buyer and get it sold, and your bond can get sold. Here there is an element of mark to market, where if the bond prices fall at the time, if they have come down from the time that you had invested, you would be getting a mark to market gain. And obviously this is subject to movement of interest rate. Here we have assumed that if and also, like you see, if the bond had to mature in next 2 years, obviously interest rates would be lower, so there would be a small element of gain again over and above the returns that we have mentioned here. So we are not factoring in any assumption here that after 3 years interest rates would be lower. We are just trying to say, if you exit, what would be the clause. If there is any kind of gain, the returns, absolute return would be higher than 4.8%. It could be 5.2 or 5.3% also. And hence, if you see a lot of institutions and a lot of treasuries invest in these government bonds because of the liquidity option, because of the interest rates, and also because of the capital gain that they can make after if interest rates fall. So the key job of a treasury manager is to make most of the interest rate cycles and the interest rate movements. The third option here is to invest through mutual funds. Now this is a little bit exciting for the HNIs or anybody who is paying higher taxes on his income. So if you buy a mutual fund, or say a debt mutual fund which is investing purely in a government bond maturing on a fixed day, then we have assumed again today's rates, which is around 7%, there would be no payout given to you during the course of these investments. Now, if most of the working class, they say we don't want any payouts, we want to reinvest this money. So mutual fund definitely allows you not to take any payout. It's up to you. The liquidity option is there. You can enter in anytime, exit anytime. But obviously, if you don't want interest or any payouts in between, you can opt for the growth option where there is no payout that will come to you. So hence, what happens after 3 years is the government of India has a different taxation for debt mutual funds. They say if you hold it for over 3 years, you can claim indexation benefit. Now we have explained in our next slide that how indexation benefit works. But just for ease of understanding, the taxation is slightly lower than what is considerably lower than what you normally pay for a fixed deposit in banks or when you buy a bond directly. So as a thumb rule, we have just considered 0.10 as or 10% interest being taxed, and that's why your returns, net returns, would be 6.6%, assuming certain inflation, which is similar to the housing index that you use to calculate capital gains. It's just the same thing. Here your net returns would be about 6.6% compared to 4.12 or 4.8 in terms of government bonds or fixed deposits. So the tax, the return loss due to tax is about 40%, which is considerably lower than what you pay in fixed deposits or direct bonds. Also, liquidity point of view, mutual funds offer the liquidity on the very debt. Mutual funds give you liquidity on the very next day. Most of the funds have T+1 settlement, so you get your money on the very next day. There's no question of you looking for a buyer or seller or anything. It's pretty easy, and that's why we have said the liquidity is very high. And the benefits that we have assumed here is if you sell it after 3 years. Any investment sold within 3 years, it would attract normal tax rates as per your income slab. We have covered this point later on also. And mark to market gain is similar to what it would be in bonds. And since government bonds are traded very actively, if the interest rates have come down from the day that you have invested, definitely there would be a mark to market gain, and you would get your net returns would be more than 6.6%. And if the yields have gone up at the time of you say, let's assume that somebody had invested about 2 years ago when interest rates were 5%, and if today he decides to sell the bond, obviously he's going to have a mark to market loss, and that's why he would get the net returns would be lower. So if one does not, so how do you play this now? I would just want to focus why we are trying to tell you about mark to market gain in this slide. Typically, when interest rates are lower, one has to try to lock the yields, because any investments done in mutual funds, or most of the mutual funds who are actively traded in debt mutual funds, will get a hit of mark to market loss because of increase in interest rates. Similarly, if you buy a government bond which was fetching lower interest rates 2 years ago and now is fetching higher, there will be a mark to market loss. But at the situation where government of India bonds are trading at higher rates, and today when if you see the interest rates are already at an elevated level, probably they will go up another a few basis points in the next 6 to 8 months. And if we lock those yields, your assured returns would be somewhere around 7.5 if you hold till maturity. And if you decide to exit, if interest rates come down in the next 10 years, I'm sure they are, like I showed you in the earlier charts, that interest rates do move in cycles and they keep going up and down. So 3 years down the line and 4 years down the line, if inflation is under control, there is a high possibility that you would get a mark to market gain in all the investments that you do in bonds or in debt mutual funds, especially the government securities that we are talking today. We are not talking about any specific security, but anything that is sovereign in nature is what we are talking. And fixed deposit, we have just considered HDFC and SBI's rate as per the charts they have put on their website. So what we are trying to do in this slide, or if you see the slide that we have tried to present here, is what are the benefits of investing in mutual funds and in bonds or doing a traditional fixed deposit. So if you want regular payouts, then you have to go for traditional fixed deposit plans or buy a bond which will give you semi-annual interest rates. If you buy a mutual fund, there's nothing specific that it would pay you on a regular basis. All you can do there is do a systematic withdrawal and assure yourself a fixed return. But definitely it doesn't come in with the plan. So we have tried and we have specified here, can be created artificially via systematic withdrawal plan, which is SWP. So if you do a fixed deposit, do you get indexation benefit? The answer is no. If you buy a bond, do you get indexation benefit? The answer is no. But if you buy a mutual fund, definitely you get indexation benefit, and the net tax outflow would be considerably lower than what it would be in fixed deposit and buying a bond specifically. Now, tax on interests that you received on these fixed deposits or the bonds is it is as per your income slab in case of fixed deposits and in case of bonds if you buy. But in case of debt mutual funds, there is no specific payout that runs to you. So, or there is no, since we have opted, we assume that we are going for a growth option, there will be no tax implication till the time you redeem those investments. So that's why we are saying no specific interest is been credited to your account. So that's why there would be no tax outflow for you. So if you see anybody who is probably in his early 40s and wants to invest in a government bond for 20 years and he is not wanting to take back any interest rate, he should ideally look at these debt mutual funds which will mature exactly 20 years from now and invest only in government bonds. So his yield would be assured. You can check the yields in their fact sheet, and that would be the net returns less the expenses, which would be very nominal because these are all index funds. So the yields mentioned on the fact sheet less the expenses that the scheme charges, and it would be your absolute return. And here till next 20 years there would be no tax outflow. Only when you redeem it or when it matures there would be a tax obligation, and which is what you are looking for. Also, if any senior citizen is looking for regular payouts, then he should not buy mutual funds straight away. He could either go for bonds where he would get regular payouts, and there is a equal possibility of capital gain which can happen in bonds also, which you have covered here. So, is there a possibility of getting any kind of long-term capital gain tax in mutual funds? Yes, there is. Is there a possibility of getting long-term capital gain tax in bonds? Yes, it is. And any gain that comes to you from bonds, you would be taxed at 10% if it is sold anytime after 1 year. But in mutual funds, you have to hold it for 3 years to claim the indexation benefits. Post indexation, the tax is 20%. With indexation, it's called 20%. And without indexation, it would be 10%. But in case of fixed deposit, there is no case of making any capital gain or capital loss, because it is just that if you hold it till maturity, and there would be no mark to market gain, no mark to market loss, no capital gain or capital loss. But definitely there is no possibility of making higher returns or in these bonds also. So what we are trying to say here is, if we are at the lower end of inflation, and if we think we are at historic lower levels, which probably we were about 2 years ago, where the inflation was sub 4%, that was the best time to do bank deposits, because it was assured to you, and obviously you know that when you start consuming and things normalize, inflation will come in and interest rates will start moving up, which is what exactly happened right now. Since last 2 years, the best thing to do was any investment which would give you fixed returns. Now is the time when you think that inflation would cool off in the next 1 year, then you slowly start acquiring the government bonds, or you go through mutual funds which will mature after 5 years, 10 years. Also, if you see, a lot of people want fixed returns for a very long duration time. Banks do not offer these kind of options. So you can do it definitely by buying. Government of India issues a 20-year bond, issues a 10-year bond, issues a 5-year bond, 7 years bond, and they are all actively traded. So you can always plan your long-term retirement goals or your fixed income kitty during such times, so that your assured returns. So now Government of India is borrowing for 10 years at about 7.4, and about for 15 years or 20 years they are borrowing at about 7.7. So if one had to plan his long-term investments in debt, it would be the best time to assure and lock his returns at these levels. So this is just a personal opinion about how one can look at various cycles, or various how we can extrapolate from the data point that we have right now. Now the last is the indexation benefit, which I have been talking for mutual funds. If you see, everywhere we have said that there is an indexation benefit when you invest through mutual funds. So we have tried to explain here that 35% is the cumulative returns, 25% is the inflation assumption. Now obviously this is an assumption. This year we would have maybe 6% inflation. Last year it was about 4%. It could be 5% next year. So every year government will declare these figures, and we will have to extrapolate whatever figures they declare every year. But for ease of understanding, we have said on an average we will have 5% inflation for the next 5 years. So 25% of the returns you don't pay any tax, and the rest 10% over and above that you have made, you pay 20% tax on this, which is 2%. So your net returns would be 33%. So this way, if you invest through a mutual fund and hold it for over 3 years, you have the option to claim for indexation benefit, which reduces the tax liability. So in debt, you can't do much because the returns are pretty assured. You can't outperform or do any smart thing there to make like in equities, you could identify a stock at lower valuation and make about 100% returns. In debt, outperforming by about 2% or 3% is a huge thing. So this is only way this is one of the ways by you can reduce your tax outflow and get the net absolute return to be higher than what you would get by investing a fixed deposit or a bond.
So Jaydeep, that was complex. it was complicated, and one of the things that we want to do at Swatantra is to actually help people make decisions and be in control of their decisions and their money, right? I think education is important, awareness is important. Yes. We should know what government bonds are and how we can use this investment vehicle to make money. And now seems to be an opportune time to do so. So now I want to invest in this. How do I go about it? Who can help me? Or it's not like I can go on Zerodha and buy it, right? So maybe you can help just decode that.
Yeah, so the easiest way to buy government securities is buying through a mutual fund, a debt mutual fund. These are typically index funds with a roll down maturity. That means they will mature on a specific day, and you would know upfront as to which bonds they have bought in that. So it could be 5-year, 10-year, 20-year, whichever you want. Second way is RBI has a platform called RBI Direct, where gradually they are going to make sure that retail can go in and buy any bond as low as 10,000 rupees also. So that would be one of the options going forward. Right now it's pretty illiquid and it's in the nascent shape. And the third option is to buy it through your brokers. Institutional brokers buy it in bulk and they give it to the individual retails by keeping some spreads. But that is also a good option because you save on the recurring cost that is there in managing it.
So thanks a lot, Jaydeep, and all of you, thanks for sticking around on this podcast. Now this is a little technical, research heavy, analysis heavy podcast. But making money isn't easy. Your hard-earned money also should make money. And so you need to level up your knowledge base, go into the depths. Hopefully you don't make mistakes. Through the guidance of people like Jaydeep and Rushabh. And that's what we are here for. So, this is not all inclusive, it is not supposed to be, all things to know about government securities, right? This is a starting point. We are just helping you get started. So, hopefully, at the conclusion of this podcast, you get interested enough saying there is money to be made in a very secure and a safe way. So let me now spend the next 2 hours, 3 hours over this weekend about these securities and how I can make money and reach out to that broker or buy that mutual fund as Jaydeep suggested, right? Decision has to be yours because it is your money. And so with that, we are going to conclude. If you like this, please share it with 5 people that you know who want to make more money. Who want to learn how to invest on a much more serious note. None of the things that we say over here are to be considered as advice, right? You are in charge of your own money. Take the decisions, understand it, do your own analysis, build the conviction, and earn or create your wealth. We'll see you next time. Thanks a lot.